Ever wonder why the price of silver seems to do its own thing, even when you see tons of people buying coins and bars? You're not alone. Most investors check the spot price and think that's the whole story. But here's the secret. The real action, the thing that actually drives the price, happens somewhere else entirely. It's not in your local coin shop, it's not in jewelry stores, and it's not driven by small retail buyers like you and me. The short-term price of silver is almost entirely decided in the futures market. If you don't get how this works, silver's price movements can feel random, delayed, or even rigged. So let's break it down, nice and simple. First, what is the spot price? This is the price you see on financial news sites. The current market price for buying silver right now, for immediate delivery. It's the global benchmark. But here's the twist most people miss. The spot price doesn't lead the market, it follows. It's a reflection of what's happening in the futures market, more like a scorecard than the game itself. So, what are silver futures? A futures contract is just a deal to buy or sell silver at a set price on a future date. These contracts trade on massive exchanges, and this is where the big players hang out. Unlike buying a physical silver coin, futures trading uses leverage. This means traders only need to put down a small fraction of the total value, called margin, to control a huge amount of silver. This creates insane amounts of trading volume and liquidity. And wherever you find that much liquidity, you find price discovery. That's where the price is truly set. So who are these big players in the futures market? There are three main groups. First, you have commercial hedgers. These are the silver mining companies and industrial users like electronics manufacturers. They use futures to lock in prices and protect themselves from risk. Second, you have the big institutional players, hedge funds, banks, and asset managers. They're trading based on the big picture inflation, interest rates, and the global economy. Finally, you have speculators who are trying to profit from price swings and, in the process, add even more liquidity to the market. Retail investors. We're in there, but we're a very small piece of the pie. So, the big takeaway is this. The futures market leads, and the spot price follows. It's where the liquidity, leverage, and institutional money are all concentrated. But that brings up a really important question. If everyone is rushing to buy physical silver, and coin shops are sold out, why doesn't the price on your screen immediately shoot up? We'll tackle exactly that in our next video. Make sure you're subscribed so you don't miss it. Thanks for watching. You've probably seen headlines claiming that retail silver demand is surging. Coin shortages, rising premiums, strong buying interest, yet the global silver price barely moves.
Why does that happen?
Because retail coin demand is not the primary driver of global price discovery. Let's explain why. Physical market versus futures market. There is a major difference between the physical silver market and the futures market. The physical market involves real bars and coins being bought and sold. The futures market involves contracts representing silver exposure. Scale difference between these markets is significant. The futures market handles far greater trading volume and liquidity on a daily basis. And in financial markets, price is determined where liquidity is deepest. Premiums versus global price. When retail demand rises, coin premiums can increase. You might pay more above the spot price for physical silver. But that premium reflects local supply and demand conditions, not global price discovery. The global silver benchmark still comes from futures trading activity. So even if physical demand feels strong, it does not automatically shift the global reference price. Markets are forward-looking. Another key factor is expectations. Institutional participants in the futures market position themselves based on forward-looking analysis. They evaluate economic data, Federal Reserve policy, inflation expectations, and currency strength. Positions are often established before headlines become mainstream, so by the time retail investors react to news, futures markets may have already priced in those expectations. What feels like a delayed reaction is often simply prior positioning. Final structural conclusion. Silver pricing is not random. It is not primarily driven by coin shop activity. It is shaped by institutional positioning, commercial hedging, liquidity concentration, and forward expectations inside the futures market. Once you understand where price discovery actually occurs, market behavior becomes far more logical. And in financial markets, structure always matters more than noise. If you value clear structural analysis of silver and precious metals markets, this channel focuses on exactly that.